Joining me now, the editor of The Next Big Thing Investor Pro at thenextbigthing.com. From Newsmax, New York, it's Tobin Smith. Tobin, we welcome you to America's Forum.
Thank you. It's good to see you, JD. Long time.
It has been a while, but here we are together on Newsmax TV. And Tobin, I look to you to make some sense of the current situation on Wall Street. Why do you believe we're seeing one record high after the next?
Well, JD, there's sort of three factors at hand here. Number one, the Federal Reserve obviously made the decision, 2-3 years ago that one of the ways we were going to stimulate the economy was to make money basically free. And so when money costs 0.25% to all the big guys, they borrow that money and then they buy assets. And this financial asset reflation over the last really 4 to 5 years is all relative. Remember, it's all got to be relative to something, and it's all relative to that 10-year bond, right? So who thought at the beginning of the year that a 10-year Treasury bond would pay you 2.5% of what it does today? So relative to buying a essentially a 25% return over 10 years, if I can buy equity assets that we think have farther to go just on a valuation basis, but then I'm getting dividends higher than a 2.5%, right? That's a pretty good bet, and that's what's happened. It's all relative to how cheap and low price long-term yields are, and so everything has to be priced relative to that. So that's one thing that's happened. The second thing that's happened is that we had at the end of last year, the market, JD, runs by the big money, and the big money are the hedge funds, mutual funds, et cetera. That's probably 75% of the money out there, and the other part is the very short-term money. You've talked about the high frequency trading guys, and that's about 50% of all the volume every day. So if you take those two forces, they decided last year that since they were doing so bad against the normal market, that they really jammed up a few of this really high-flying stocks. So we had high-flying biotech stocks, we had the cloud services companies, and we had social media, and they were like this, right? And then they crashed in February, and they crashed hard. I mean, we had stocks down, JD, 75%. It was like being in March of 2000, and that scared the bejesus out of these people. So what did they do? They all of a sudden said, all right, we're going to lower our risk, and we're going to get out of these risky small cap stocks and no income and no revenue and no earnings stocks, and we're going to go back to the safety. And that's what we've seen since April. We've seen this real divergence between small caps now losing value, losing money, and the larger caps, the S&P 500, the NASDAQ QQQs, the top 100 companies going up in value. And that is a flight to safety play, JD. So that's why you have the indexes hitting higher highs, but not all the stocks are participating, and that's what worries a lot of people.
Well, you set this up, a perfect place to ask this question. Under these conditions where size equates with safety, does that have anything to do with these high-profile mergers in the media marketplace, Comcast, Time Warner, AT&T, and DirecTV? Is that playing a role in what's going on here on the street?
Absolutely, and particularly it was a part of the these new fast-growing technology companies. Because look, we got a GDP that is not going to grow more than 2.5–3%. Despite what the Obama administration says about, remember, we're supposed to be growing at 4% according to their very, very bad prognostication. So we're going to grow at 2.5 to 3%, and that's mostly because we got 5,000 people retiring, turning 65 every day. We're losing people from the workforce. If you're not working, you're not spending. So the economy in a slow growth mode means that a tech company needs to buy growth. They need to buy new companies that are going a lot faster in the economy, and that has added to it. Obviously, the consolidation in the media business sort of gets the headlines, but we've seen it's actually $2.5 trillion of mergers over the first 5 months of 2014. Total record, never seen it before. So yes, what that does do is say that if everybody's for sale, what you don't want to be doing is, as a professional investor, is betting against a company on Friday and then on Monday having it go up 25 or 50% because it gets bought out. So that scares out all what's known as the short sellers, the people who are betting against the market. And that is raising valuations in a lot of companies, because to grow now in a slow growth economy, the big guys at the top of the food chain They got to buy people, and that's where this merger and acquisition, M&A, has all happened, and that really does sustain the price. The other thing, quickly, JD, is the large companies with all the amount of cash are buying back stock. They're buying back their stock at a record rate. There's more stock being taken out of the stock market than's going in. So a little supply and demand here. If there's less stock, just like if there was less, shirts or ties or cufflinks, the value is going to go up. And that's the other part that's driving the market.
So you have those highs on Wall Street. Now, what's going on elsewhere in terms of all-time lows? For example, the Chicago Board Options Exchange Volatility Index, the lowest it's been for 7 years. That VIX, a measure of investor expectations for stock market volatility during the coming 30 days. Now, judging from the index's recent form, what do you think about the coming months? Is it a favorable time for both the overall economy and wise investors?
Well, JD, I've been doing this a few years. This is Norwegian blonde hair that I have here. And one of the things that you learn is you never want to confuse the economy with the stock market. Because the only 2 times, in a life cycle does the economy match the stock market. And that's at the bottom when the economy has completely shrunk and turns up. And then way at the top where we're getting ready to go back to a bear market. Other than that, they're really not related. I know that sounds strange, but think about it. The stock market is looking 6 to 9 months ahead. That's what it's trying to anticipate. The economy is the economy. It's doing what it's doing. So the idea here is that this VIX, this volatility ratio being low, simply means it's a measure of fear in the market. And right now, because big money is moving into the larger cap stocks, which essentially are safer, they're less volatile, it makes sense that the VIX would hit the low. The sort of scary one is that this volatility index on the small cap stocks, however, has shot up, and it really hasn't come back to earth. And that's a warning signal saying that it's sort of like if you think about the stock market, you have the generals and then you have the privates, right? Well, the generals are the big guys, the Fortune 500 companies, and the privates, the enlisted men, are the small cap stocks. With the small cap stocks rolling over and essentially, in at least a correction more than 10% down, and yet hitting a high with the generals, most market historians will tell you when that happens, the market is setting itself up for a correction for everybody. That means a 10% move down for the S&P. So that's what we're watching for very carefully. If the generals start to lose steam with the small cap guys, the privates have already lost steam, then we're going to get a pullback. And I wish I could tell you it's going to happen tomorrow, but I can tell you historically when we see this, the market comes back on average about 12%. And at the extreme at about 18%. And that's happened over the last 50, 60 years.
So it sounds like to me, Tobin, we got to follow that old adage: you sell in May and go away. But let me get to your model portfolio for the NBT Research Investment Newsletter. It's up 12% in a market up 2.5%. So the question is this, Tobin: how are you outperforming the market by 5 times? What's your take
I'm
now?
I'm so glad you asked that question. And it's a function of a couple things. But number one, more than anything else, is that we invest in what we call is the transformation economy. The transformation economy are the industries and the sectors and the companies that are undergoing, radical, rapid, transformational change. The difference between us and that sounds like that's just tech stocks, by the way, but it's not. But if you take one of the largest transformations going on in the world, and certainly in North America today, it's something you guys have talked about a lot, which is the shale energy revolution. The fact that we're now Saudi America, the fact that we're going to be the largest exporter of oil, the fact that we're going to be the largest exporter of energy, both oil and natural gas, in the world. Well, that transformation is happening every day in front of the people in many parts of the United States, in Texas, in Oklahoma, in Idaho, and North Dakota, et cetera. A lot of Americans don't see this change. And one part that has to happen to accommodate this is building the infrastructure. And so there's $30 to $40 billion, there's $600 billion over the next 20 years that has to be spent to be able to move all that oil, all that natural gas, to get it processed and get it moved.
Gotcha.
So that business, the business of building that infrastructure, is where we're making the money.
In short, it's the next big thing. Tobin Smith, we appreciate your insights and analysis, making sense on Wall Street and Main Street and your street, too. We really appreciate it. So you hear from Tobin You got to think about the next big thing. What's your take on the economy? Love to hear from you. Why don't you tweet me your comments at Newsmax TV, hashtag America's Forum. There's also email and Facebook. You'll see our faces again after this time out.